Good morning. I'm Jen Amos at Weiss Research.
I'm Andy Myers, and this is your morning market alert for Thursday, March 10th. Stocks on Wall Street are likely to follow the global equity markets lower at the open. Investors worldwide are selling after a surprisingly weak trade report from China. The country posted a negative balance of $7.3 billion in February, the largest deficit in 7 years. Imports rose 19.4%, but exports grew just 2.4%, hurt by the Chinese New Year holiday. In January, China posted a $6.5 billion surplus, and economists had expected a similar number last month. The report prompted a sell-off in Asian shares overnight, as investors worried that a slowdown in the world's second largest economy could affect global growth. Here in the U.S., traders are reacting to a reading of January international trade, along with the weekly jobless claims report. We'll bring you that data and all the market reaction after the opening bell.
The major markets across Europe are also broadly lower, due to China's trade deficit as well as a downgrade of Spain's debt. Moody's cut the Spanish government's sovereign debt rating one notch to AA1, bringing it in line with Standard & Poor's rating. Moody's also put a negative outlook on Spain, a signal that a further cut is possible. The company said it's concerned about the government's ability to improve its finances, and that the restructuring of the nation's banks could cost more than expected. U.S. traded shares of Banco Santander and BBVA, Spain's two largest financial institutions, are both dropping about 3% on the move. And it's also giving currency investors an excuse to liquidate long euro positions, sending the shared currency sharply lower against the U.S. dollar.
The dollar is also rising against other major currencies, including the British pound, following a decision on monetary policy from the Bank of England. The central bank left its key lending rate unchanged at a record low of 0.5% as expected. The Bank of England also made no changes to its £200 billion program of asset purchases. But analysts say the decision may have been a close one as policymakers attempt to balance inflation pressures and uncertainty over the strength of the economic recovery. London's FTSE 100 is losing about 1% right now, dragged down by a 6% drop in shares of ARM Holdings. The chip maker is also lower in U.S. pre-market trading after J.P. Morgan Cazenove said weaker than expected sales of non-Apple tablet computers is likely to hurt the company's stock price. The analyst predicted that the supply of tablet computers could overshoot demand by more than 17 million units this year.
In addition to all the economic and corporate news investors are watching this morning, they're also keeping a close eye on oil prices. Light sweet crude is dropping nearly $2 and is now back below the $103 a barrel mark. Today's decline is due mainly to the surprise trade deficit in China, which traders could be reading as a sign of cooling demand for commodities in the future. This is the third straight drop in oil prices as supply worries ease amid reports that OPEC could raise production to offset disruption in Libyan output. However, analysts say prices are unlikely to fall much further as long as the fighting in Libya continues and tensions across North Africa and the Middle East remain high. That's the latest from Weiss Research. We'll be back after the opening bell with all the economic data and market reaction.